But the important thing that I see here, beyond just the supply and demand issue, this is huge. And who are the people that are generally so good at shorting that they make profits at it? Hi, it looks like there is something really important happening in the gold market right now. And we're going to get to that. And Alan and I are going to analyze this. Alan, how are you doing?
I'm great, Mike. Thanks. How are you?
Great. So first, there's some housekeeping items that I want to go over. And the one thing, Dan, can you put up my screen? My book is back on Amazon. It took a long time. It was a couple of months now. With the problems that we have with Amazon and the problems that we have with the fulfillment house that stores the books and then ships them to Amazon. And so we are overcoming those problems right now, but the book is back. The other thing that I have is that if you applied for the assistant position and I haven't contacted you yet, don't worry and don't send another resume. I am going through all of these. This is something that's personal where I'm working with somebody. So I actually have to be the one to go through all of these resumes. And there were a couple hundred submissions and I just get very burnt out on them. So I need an assistant to help me find my assistant. But since I don't have an assistant yet, it is going to take a while. I should be done with them within a week. And at that point, I'll be contacting the finalists and having them down to Puerto Rico to get to know them better and then picking one. So please don't send any more resumes. And you'll hear from me when I have picked one so that you'll know if you are one of the finalists or the position has been filled. So Alan, what do you have for me?
Well, Mike, basically it all started with a tweet from Bob Coleman. And he said, I want to read it for you. This came last week on October 19th. He said, very strange events happening with GLD ETF. Since the events in Israel began, GLD has seen outflows of over 500,000 ounces. That's over $1 billion in assets. In the meantime, the price of gold has moved up $130 per ounce. Very suspicious. On top of that, the shares available to borrow, that's for short sellers, the shares available to borrow just went off a cliff. It used to be 3 to 4 million shares. Now it's 150,000 shares, and the borrowing fee is rising. So this is suspicious. It seems like an issue of supply and demand. There's not a lot of shares available to borrow, and so if the demand stays the same or goes up, the fee is going to go up to meet it, Mike.
Yeah, the one thing I want to point out to people is that GLD is not gold. And the very fact that you can short it proves that. You buy GLD, and if you have a margin-enabled account on your trading platform, you buy what you think is a certain number of ounces of gold that you think you have title to. And but you have shares in a fund, and that fund can be shorted. And when you short a fund, the brokerage house borrows shares. Then he could, if you're long GLD, some of your shares could be borrowed and sold short. And so you think you own ounces, but those ounces have been borrowed and sold again. So two people think they own the same ounce. This is just one of the many reasons that GLD, SLV, these exchange traded funds for precious metals, are not precious metals. It's shares in a fund and the fund might have title to these precious metals. If the fund has a problem and there's a force majeure or something, or some liquidity problem, and all their prospectuses also say things like, during certain market illiquidity events, the price of the iShares may diverge from the price of silver and fall. Stuff like that. So just realize these are good instruments for day trading. But if you're investing in precious metals, It's something to run. I mean, you want to run as fast as you can in the opposite direction. This is not owning precious metals. But let's go back to that again for a second, because there was a series of these charts, wasn't there?
Yeah, there's a series of these charts. There's 3 of them, which came as a part of 3 separate tweets from Bob Coleman. So again, shout out to Bob. Thank you for tracking this and bringing it to everyone's attention. But let me just explain quickly what's on this chart so that viewers understand. It is a little complicated and it's not very well labeled. So it did take some digging.
Exactly. We were having an issue with this, and that's what delayed it. It wasn't until his second posting on x.com, formerly Twitter, that I figured out that which line was which. You and I figured out these things. So
yeah, exactly.
Because of the poor labeling, and then there was nothing describing which line was which. It's pretty obvious that the gold line in the background is the gold price, but yeah. So go ahead.
Yeah, exactly. Like you said, the gold line in the background is the gold price, but it's not labeled. There is no y-axis here. The y-axis is a percentage, but of course, GLD isn't a percentage, it's points. So it doesn't quite drop to 0 here. It just was a temporary dip, but then it recovered. So that's the gold line. The gray bars in the background are the shares that are available to borrow. And the reason you would borrow these shares is so that you can short them. And we can see that they're dwindling in the last week or 2. Mm-hmm. Finally, the red and green candles in the middle represents the fee to borrow one of these shares. So it's basically the price, the cost of taking a short position. And the candle spiked up recently, and at the same time, the number of shares available to borrow is dropping. And this is really the red flag that Bob raised on Twitter. And like Mike said just a second ago, this is only the first of 3 charts. So let me move to the second one and show you how this developed just 4 days later.
And then read his,
Yeah, so here's the second tweet. GLD ETF alert. Borrow fee to short to short shares of GLD doubled from Friday. So the cost to take this short position has now doubled over the span of 4 days. And it's about to surpass the temporary spike on August 30th. And you can see this massive green candle here on the right side of the chart. And it's just about to pass this really high, this intraday high from about 2 months ago.
Yeah, for anybody that doesn't know a candle chart, you've got an open, the intraday, and then the close. And that big green candle on the end, the open is the bottom and the close is the top. The previous August 30, where there's that wick sticking out of the candle, that big tall wick. So it opened at the bottom, it went all the way up to the top of that wick, and then came back down and closed at the top of the fat bar, the fat part of the green candle. Just, for anybody that doesn't understand what that little spike is sticking out of it, that was just something that happened in the middle of the day during trading. And then it came back down. But here we are closing in an uptrend. And to me, this suggests that something is up. So what else do you have to say on that chart?
Yes, exactly. So we can also see the gray bars dwindling close to 0, meaning there's not a lot of shares available. Supply is drying up and the price is moving up to reflect that. So let's go to the third tweet. Bob finishes it up with another GLD ETF alert. He says the borrowing fee to short GLD just moved to a 3-year high. A 3-year high. Look how massive this set of green candles is.
And notice that the candles are really skinny. This is a longer time frame now.
Yes,
right?
Exactly.
And this point out the August 30th candle.
Right here.
Yeah, right
I
there.
went too fast.
Exactly. Yes. So we have doubled that intraday high of the August 30th candle. So in other words, there's just no shares available, and people are paying a fortune now to be able to borrow them and sell short.
Yeah, exactly. Like the normal volume of shares available is somewhere between 3 and 4 million shares. 3 and 4 million. We're down to 100 shares. 100 shares.
Okay.
It's like basically nothing.
So where those shares come from? I don't know what percentage the brokerage houses are able to borrow out of your account without telling you. But if you have a margin-enabled trading account on Fidelity or Schwab or Ameritrade or something like that, they can go in and borrow their shares. When you log in, it doesn't show that they have been borrowed. And then they can loan them out and charge interest in these fees to the borrower. So it's basically fractional reserve lending with, and they're not really telling. It's in the disclosures are in the agreement for opening a margined trading account, and I don't know what percentage the brokerage house is allowed to borrow. So the number of shares available would be limited. But the important thing that I see here, beyond just the supply and demand issue, this is huge. And who are the people that are generally so good at shorting that they make profits at it? That's the professionals. Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. And so there is, and when people go short, if the price falls, there's a point at which they cover, and then the price bounces. So there are a lot of people here thinking that gold is going to fall soon. Do you get that from this?
Yeah, or at least they've been betting that way for a while, and they're sort of running out of ammunition. If they want to maintain that trade, there's not going to be any shares available to continue.
Oh, yes, that's right, because the shares are dwindling. The price goes up, so they're already short, but they're now paying more to stay short.
Exactly. That's how I interpret it.
Okay. Well, I interpret it that why is the outflows happening? Why did the available amount of shares to go short vanish? Some people, a lot more people must be going short here, unless like is the number of ounces that the outflow, that's nowhere near like 50% of what GLD is. It's a very small portion when it comes to the outflow. This is just showing, this is sort of revealing the positions that people have, long or short positions. And so anyway, have you got any other comments on this chart? Because I want to show you some other charts that I think also reflect on this.
Yeah, I guess the last thing I'll say here is the outflows could be, I mean, I'm just speculating here, but the outflows could be some of these major institutional players that are actually redeeming their baskets of shares to take delivery in gold. I don't know.
Yeah.
But it could be that. But in any way, that it seems like a bullish sign. No matter what explanation you come up with, whether it's taking gold out of the ETF and into storage or something else, it seems like if it's going to be harder to take a short position, people aren't going to be able to bet against gold like they traditionally can. So I look at this overall as a bullish indicator, regardless of what the reasons are underlying it.
Yeah, I think you're absolutely right. And the thing is that if I owned GLD or you owned GLD, we can't redeem those baskets. Mm-hmm. It takes, first of all, I can't remember exactly the size. Huh?
100,000.
$100,000.
100,000 shares.
Shares, and each share is what is the price? Okay, yeah. So I mean, it's huge, and then so it is mostly institutional. It's mostly bullion banks and very, very large institutions that can actually redeem their shares and get gold out of GLD. Most people can't. But to me, this also means that there could be a very short-term pullback, a little flash crash or something like that, where these people that are on the short side will make a profit. But what happens, what stops a market from falling to zero are the short sellers. They're making a profit on the way down, and they have to try to guess when that market might reverse, and they need to cover their position and buy back their shares, which is positive price pressure. So when they buy back, that causes the bottom to come in and the price to reverse, and it rises again. So it causes volatility in the market. But if these people may end up making a profit, who knows? But the very fact that the same ounce can be sold to two different people is very it's immoral to me. Anyway, so I'm going to show you something. So Dan, if you could share my screen. This is the Commitment of Traders report. And so this is gold and silver futures. This one's silver. Let's cover gold first. And one of the things that you see here is that big rallies, such as this one here, come from fairly low levels of what is called the commercial net short. Now, net, you take the longs and the shorts from the non-commercials, mostly funds and like pension funds and things like that, and then these non-reportables are small traders. And the non-reportables, there's a black line in behind the red area here, the red bars. So that's the non-reportables. When you add the non-reportables to the non-commercials, the red bars, that equals the exact amount of commercial net shorts. So you've got a certain number of contracts here. 600 open interest, last 440. And then you have to deduct if commercials are both long and short, and they are, and there's a reason. These commercials, a lot of them are the bullion banks that, for instance, when a client of ours is making a large purchase of gold or silver, we will lock in a price by buying or selling a futures contract. And then we find the gold or silver. And when we purchase the gold or silver, we buy back or sell back the futures contract at the same time. And what that does is neutralize price fluctuations. So the price can go up or down by 10% during this time period, and we can still make a 1% profit either way. It doesn't matter whether if we quote you a certain price, we're going to live up to that certain price. Whether gold goes up 10% and we have to buy it 10% higher, the futures contract will neutralize that. We'll make a profit on the futures contract, even though we're making a loss on the physical. And so the industry, a lot of the industry is in these trades. And what we've just seen lately is with this gold price rise up here, we've seen also note that the Commitment of Traders report is like a week late on the net position. That's a week late. The gold price is not. That comes up to today. So as of a week ago, that was increasing. It probably kept increasing. And so we are seeing something a little bit more live with those charts that you showed of the GLD outflows and the position of the available short selling shares. Now, with what you see here, though, when this reaches low levels, that is when a big bull market can start. We had fairly low levels here, and we see this big price upswing. If we go over to silver was actually at a commercial net long position right here. And look at what happened. It went from $18 up to $24 after it had been at that minimum. And part of this is just caused by how many people are buying and how many people are selling, and the position that the commercials have to be in because of the buying and selling. And so we are now at a position where there is room for a price pullback. But just remember, that is an opportunity. It's not something, it's short-term price noise. In the long term, gold and silver are, I believe, headed for the moon compared to most other assets. And I think that that a lot of these people that are gambling with day trading and so on, when you're in futures, you're leveraged and you're in paper, gold and silver, and there might be 300 people that actually think they own the same ounce of silver or gold. And when there are times when it reaches that number of paper ounces being traded on top of the actual physical that's in the vaults that's deliverable. And when you're dealing with GLD, if somebody can sell it short, it means that not all of the ounces that have been sold exist. And so I steer clear of these things because I think that there is plenty of gains to be made that you don't need to introduce leverage to win.
Yeah, absolutely. And to your point, there's one other thing that sometimes people overlook, which is for GLD or SLV, the management fees actually come out of the precious metals. So they sell a tiny bit of gold or a tiny bit of silver to pay management fees. So even though when the funds start, it's backed 1-to-1 by the metal, over time, it drops down more and more. So originally it was 100% about 20 years ago in 2004. Now it's down to only about 94%. And that's going to continue. So the way the management structure and the fee structure works is that the ETF is actually designed to go to zero in terms of how much gold it will eventually be backed by. Now, that might take a couple hundred years, but eventually all that gold will be used to pay for management fees over hundreds of years, and there won't be any gold left.
Yes, exactly. So, yeah, I steer clear of them, but I do believe that something big might happen soon because of I look at this indicator that we just went over, the shares being sold short and the fees, as sort of a leading indicator that there is something big about to happen in the precious metals sector. And either this was caused by the outflows or it's caused by more people going short, and that would be the professional traders that sort of have an inside glimpse of the future.
Yeah. Well, all I can say is we'll stay on top of it. We'll keep doing our research, and we'll bring exciting updates to people as they unfold.
Okay. Thanks a lot, Alan.
Yep. Thank you, Mike, and thanks everyone for watching.
Yes, please like and subscribe.
Thanks for watching, but this is by no means the whole story. If you want the full story, including my free online-only chapters and companion videos, there's a wealth of information at ggsr21.com. Thanks.